Hey everyone, it is Evan here from the Trade Risk on Tuesday, April 14th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So we're going to jump right into our market technicals dashboard. You can see a nice sea of green here, bulls continuing to march this market higher. Here on Tuesday, all of the major indices closed firmly in positive territory, led strongly by the Nasdaq 100 up over 4% today. 5-day change numbers all firmly green here as well. Russell 2000 out in front, but anywhere from about 6 to 9% across the major indices over the past 5 trading sessions. Bulls certainly getting the best of this bounce, and we have recovered above the 10 and 50 and 200 SMA across in the Qs specifically, and then all of the other majors we're still waiting for for them to get above the longer term moving averages. Now, if we scroll down a little bit further here, take a look at sectors. You can see materials, discretionary, and utility. A pretty interesting bunch up there, but they are at the top of the leader list here over the past 5 trading sessions. And on the downside, we have industrials, we have transports, and consumer staples, all still firmly green, but underperforming on a relative basis. Now, for major markets, we have the high yield. So this is debt market, this is credit market. High yield up number 1, followed by the S&P 500 and silver. And on the downside, we have volatility unwinding some more, followed by USO, which is still stuck and trying to stabilize, and natural gas in the bottom 3 over the past 5 trading sessions. So with that look, let's jump into the charts now, where we'll look at the S&P 500 to kick things off. We always like to start with the weekly time frame, and this is the cash settled market. So we can see here, of course, only Tuesday, but the market is up about 2% so far on Tuesday, coming off of a long weekend. Markets were closed this past Friday for the Good Friday holiday. So they had the long weekend to digest. We did start off the week on the downside, but we came, really roaring back today. And today also sort of kicked off earnings season. So earnings season is something I think all of us, all investors out there, are pretty much expecting some fairly dismal reports and numbers and guidance, if giving any guidance at all. And the question, and the interesting question, will be if we have priced in, if the market has priced in enough of sort of the bad that we should expect out of these companies. So, of course, we did fall 35% over about a month of trading, and we have since rebounded off of those lows fairly aggressively. But it's now going to be interesting to get some more data in from some of these companies to start to figure out, what is fair value, what is, the collective willing to pay for some of these stocks based on what they tell us about some of the impact that they've suffered over the past quarter. So certainly going to get a lot of data points over the next couple of weeks. So again, as we come into earnings season, double check any of those holdings that you have, and do be prepared for sort of an increased number of headlines coming out over the next couple of weeks. So here, when we look at the price action, we are seeing the S&P 500 continuing this bounce. It's been going on now for about 3 weeks since we bottomed out back here at the week of the 27th, and we now find ourselves approximately 30% off of the lows here in the S&P 500, and that puts us about 20% from highs. So we have made a very impressive market move here over the course of these 3 weeks. And again, if we throw on some fibs and we just look at kind of the impulse leg or the highs here that started all the way down to the lows from a few weeks ago, you can see we are now over the 50% retracement, and we are working our way higher into the 61.8% retracement. And, this is where it's really going to be kind of sellers' last stand, if you will, up around 2,900, the mid 2,900s. Usually that 61.8% retracement that's going to be the extent that you tend to like to see markets retrace to maintain trends in a particular direction. So in other words, if we are thinking that, this leg, the greatest move down here, the greatest impulse leg is still this leg down that we saw over the course of February and March. If this downtrend is going to continue, if the sellers are going to remain in control here over this time horizon, then it's in their best interest, so to speak, to kind of prevent the bulls from kind of pushing back over the 2900. That's sort of the battleground framework, or the way you could sort of frame out this market. And we talked about in our last video here, I think it was this board, if we go down to a daily chart of the S&P 500, we talked about if you look at measured moves here, so if we look at the measured move of this first drive higher here off of the lows up into about the 2600s, we went sideways, we broke down, we put in a higher low, and then we started to ratchet higher. And this is where our second leg now is where we're continuing to push higher and advance. But if we were to draw this identical sort of leg one measured move to leg two measured move, it gets us to right about the 2920. Again, that coincides with the 61.8% retracement. Again, approximately, I'm not looking to be exact. And it also coincides with this gap in here as well. So there's an open gap in here back from early March. So we really have a nice little confluence in here for the market to potentially rally into. And that certainly would be an interesting test, and probably an interesting spot to look for the other side of the trade. Again, active traders and more nimble traders speaking to you on a short-term basis. So if we do get up there, based on where we closed today, it's about 2.5% more to get up into this general zone here. So that frankly could happen in tomorrow's session, because we know markets are moving at a several percentage clip on a day-to-day basis. So keep that in mind. I think that's an interesting spot to reassess. Overall, though, when we just look at this market from a broad perspective here, you can see we have continued to march higher here. The trend has remained up ever since this gap up on Monday here, this little gap and go kind of island, leave the 3-day chop behind us. The bulls have been strongly in control here, and if you're looking for that change of character, you could certainly use this more recent trend line here. You could look at a price bar, an individual day taking out a prior day's low, a break of this trend line, something like that, to signal that maybe this advance is running out of steam. So far, that hasn't been the case yet. The bulls, again, remain in control here, further kind of firming up this market environment on a longer term basis. So all in all, I think it's very constructive behavior that we've seen here. If you're transacting in the short term, it's best not to be FOMOing here without a plan. We talked about that in our past couple of videos. I don't think now that everything looks nice and rosy and markets don't go down anymore, it looks like it's safe to jump back in the pool. But once again, you have to remember that we've just covered, approximately 30% off of the lows. So, it's a more difficult proposition to be adding new exposure up here. If you are holding on to positions, again, we showed you some ways you could trail your stops based on recent price action, but if you're looking to add new exposure here, you just want to make sure you're doing it with a well thought out plan. And if you have a system or strategy that's starting to allocate now, then that's totally, I think that's fine. That makes sense. But for the traders that are just looking to not miss out on further moves and are doing it kind of by the seat of their pants, that's more problematic. So you want to be in the first camp, not the ladder. So think about that when we are starting to get into earnings season here, and as we advance through the rest of this week. All in all, from a levels perspective, 28.90 all the way up to basically this 2930 band. That's sort of the next resistance area. That's where I'd be really starting to look closely here at markets and how they react. So that's my overhead level. On the downside, 2635, that was the recent breakout level. That was the highs of this leg one. So that's what I'd be paying attention to on the downside for near-term support. You could also, once again, use this trend line here as well from the past 6 trading sessions. So that's how I'd be navigating the S&P 500. If we look at the IWM here, you can see stalling out just a little bit as we get back up into a pretty significant level. This 126 level, if we switch over to this view here, you can see we got the nice higher low that got put in place. But this 126 level, if we zoom all the way out here, has been a pretty significant level in the past. It was sort of breakout zones back in 2016, 2015, but we also have more or less that 2018 low was made right around 126 as well. So be interesting to see if the market can continue to hold up here, how this acts. And sort of one of the things we talked about was, one of the things we identified in the last couple of videos was the sort of changing of the guard. We saw the Russell, and it still is over the past 5 days, up the largest out of the major indices. So we saw a nice kind of resurgence here in the small caps, and we saw the Nasdaq 100, meanwhile, start to take a little bit of a breather here and start to underperform just a little bit late last week. Well, that trade, or that relationship that we started to pay attention to over the 3-day time period of where we were sort of observing sluggish Qs and accelerating IWM has sort of evaporated or gone away, effectively broken down after today's session. You can see the Qs got a strong bid here this week, this Tuesday here. Started the session with a gap up and just continued to launch higher here, and really had a strong bid all day, while the Russell now took the back seat of the relative performance train again. So basically we're back to our old ways, where the Qs, which had been the most resilient on the way down and basically throughout this whole period, is now back sort of in its front seat leadership group, if you will, helping fuel the charge to the upside. And once again, you can see based on the levels drawn here, there's not a whole lot in our way here up until we get to around 218 to 220 in the Qs. That's where we rallied to in very early March, and that's where the market ended up effectively rolling over for this more kind of disastrous leg down in mid-March. So that's where it looks like the Qs want to head here to retest this zone. Would expect some sellers up there. We'll have to see how the market reacts though. So for the Qs, nice launching higher this Tuesday, and they look to be in a pretty strong position to get back up into the upper teens of the 200s. So that's sort of the recap here on the major indices. More stabilization, more strength, all good signs and all things leading in the right direction for more sort of normalcy in these markets. But just keep in mind that we have gone quite vertical here, and there is still very much a case to be made that we are in some type of ferocious bear market rally, that the worst is not necessarily behind us. So we do still need to keep an open mind. We still absolutely want to be managing risk and thinking about, what that pain felt like if you were stuck in longs throughout the course of March. Well, don't go repeat that again. If you're adding new positions, remember, what that market looked like if we start to roll over again. And those are the things that'll keep you sort of prudent and hopefully alive in this type of market. So that's it for all of the environment. If we take a look here at some of the other majors, if we look at TLT here, we're still getting more of a digestion. Look at the ranges here, really consolidating, really seeing some compression here, which is great to see, because these moves here over the mid-March were just off the charts in terms of magnitude ATR. You can see we're finally coming back to a more normal historical daily ranges here for for TLT. So quite frankly, I think that's healthy. That's good. It's not totally rolling over. We're still kind of holding up in TLT along with equity markets, but that digestion, I think, is a good thing. Gold is also rallying right alongside of equity markets. We're seeing a strong bid here in GLD, up 2.5%, taking out the prior highs from this year and moving to new multi-year highs for GLD, getting closer to kind of getting back into the old 2012, 2013, 2011 trading levels back here. So from nearly a decade ago, gold getting back up to those levels. It is certainly extended, looking a little bit tired here in the short term, especially with this individual candle that's getting printed, but the trend here is certainly higher. Momentum in the bull's case right now, 158 now, that's the relevant sort of breakout level to pay attention to going forward. If we look at silver here, also continuing this march higher, again up 2% on this week. It's up for its fourth week in a row. It's back into a lot of prior supply in here from the past couple of years. So for me, again, I'm not that interested in silver, just don't see too much to really like about it, but certainly if you're involved in it, it is working. So if you have a position, there's certainly ways you can trail up that. You can keep your profits protected, looking at some past trend lines here, or looking at some of these past horizontal levels, but silver here continues to work. Now, if we go to energy, USO is back into kind of a difficult spot here. It had this exuberant bounce last week where it rallied about 40% in 3 trading sessions, and it's given the bulk of it back at this point, or I guess only about 55 or so percent of that move back, maybe closer to 60% of that move back. So it's back towards these lows. There's some prior kind of structure here. You can see back in mid-March, you could see oil was trying to hold on to this area right in here, the mid 4s in the USO ETF. So it'll be interesting to see if bulls can hold in here as well. That would be a good kind of higher low spot to effectively defend last week's surge, or 2 weeks ago, week and a half ago surge. And you can see there's still a lot of volume coming in here, and there's still some positive momentum divergence. So there is a decent amount of potential confluence in this area here to find some support, to find some buyers. We'll see at the end of the week if that actually happens. Last but not least, if we look at well, let's see if there it is. Last but not least, if we look at natural gas here, kind of disappointing as this rolls back over below the $13 area. We talked about this, in a perfect scenario, in a bullish scenario, would be holding this 13 area here and, really not giving too much more back than that. But it is starting to now, again, give back about 60% of last week's move. So really, bulls need to step in here quickly to stop this from just rolling right back over to these prior lows. So that's it. That is the full recap for this week. Remember, earnings season quickly is approaching, is here. A lot of the more popular kind of trading vehicles are probably more so next week, but you're starting to obviously get some companies reporting, so you want to pay attention to that, and hopefully you found this video helpful. So if you like it, you can subscribe on our YouTube channel every Wednesday, every Friday, market recap videos just like this, or follow us at The Trade Risk. Have a great day. We'll see you back here tomorrow for some swing trade ideas during the market session.